Hey everyone, Anton Madley here with Peak Market Watch. I'm here together with John Martinez, and as usual, after a rate discussion with the Fed, whether it's a hike or not, we are on and discuss what we think about it. Welcome, John.
Hey Anton, how are you?
Good yourself.
Doing well.
Yeah, so we had another one. Many hoped that it would be the end of it, but obviously that has not happened. So let's have a quick look at the statement there, what they came up with, uh, and let's see here. Where do we have that here? Doesn't look like that it wants us to show it. Anyhow, so I think we all know it, right? The reality is they raised by another quarter point. And the statement was clear that they want to achieve maximum employment and the inflation rate of 2% in the long run. So nothing has really changed there, right? It's kind of
Yep.
the usual thing of what we have been hearing for a long time from them. So, what's your take on this?
Yeah, I think it seems that it was the 25 basis point everyone was expecting. Our thoughts at the end of our last call was the same, and that it was fairly well communicated. I think that during the Q&A there seemed to have been the usual pressing of, hey, what's it going to take for you guys to start cutting rates? And it seemed to be very clear that that they're just going to keep processing data. Like they're just that there was not some imminent concern that something fundamentally had changed to weaken to the level where it was time. In I think in that instance, I imagine we both have had conversations where investors maybe earlier in the second quarter or having some hope that we would see something before year end. And I don't know, Anton, I don't think that I see that from those comments, or at least things that I watch in the economic news. Clearly things can change quickly, but I didn't get the impression that's what was on the table right now.
Yeah, I agree. Right. Uh, so nothing really a significant change in stance. Uh, Other than, and I think they also provided that message already the last round, that they're prepared to change their stance if the risk emerges, right, for that could impede with attaining those two goals, right?
Yep.
Uh, and obviously, based on their view, those risks have not appeared, at least not appeared yet. And I think as long as we have what they believe are strong employment numbers, we just cannot see that there is a significant change to that, right?
Yeah.
Uh, so I think that is just a fact we have uh, uh, to realize that they have been extremely focused on that long-term inflation, and as long as employment is still humming along, and the economic activity doesn't look like they are in significant distress anywhere really. It's really hard to see that they will pivot back drastically over the next few months. Uh, in his comments, I think Jerome Powell once again mentioned that the banking system is very solid, right? I not necessarily feel the same way, but obviously they do. They have more insight. I do not know what insight they have that gives them all that confidence. But as long as that is their view, then obviously something needs to break before they start to change their approach and start to pivot.
Yeah, no, I agree with you. I think we were commenting a little bit before we hopped on here, but I imagine you'd shared with me the outlook that if we look to the structured market, well, not structured market, but the securitized market, the stress there, your logic, and I agree with you, is that it has to correlate with what's going on the balance sheets and the credit profile for these institutions that are lending, that did rather lend to commercial real estate. So maybe we don't see the stress just yet, and so I'd ask you this: is it academic to worry about the regulatory data versus maybe the conversations that we have with borrowers that are talking to lenders, the lender conversations we're having? What do you think is maybe a little bit more important to investors that are concerned about rates going to the back end of this year and into next year? Because it feels like we can get caught up in the metrics that are looking backwards versus the conversations that are more concerned about the here and now.
Yeah, it certainly seems to me that way, right? Obviously, we have had SVB and Signature Bank and a couple of others that had liquidity issues that quickly turned into a crisis for them. And no bank wants to be in a similar situation. So they are not coming out voluntarily with, oh, our commercial real estate book has been deteriorating. So they are reporting what they need to report. And as we know, there is a significant lag in that reporting. And it also leaves bank a little bit of a freedom to decide whether they flag a particular loan as a, and whether it needs to require additional reserves, whether it should go on the watch list and so on, particularly when the borrower still continues to pay, even though the underlying fundamentals of the loan itself essentially would require a watch list, right? So you have situations where the loan does not meet all the covenants, but the borrower is still paying, right? So
Yep.
Are these flagged properly? Are these flagged timely? I would argue that many of those are not. And I would say a better measure of what's really happening in the banking system is the CMBS and CLO market, because that's more transparent, more and it also is providing information more quickly based on reports that are regularly flowing in. So it's that information is readily available once the reports come in, right? And based on the default rates there and the delinquencies that we see there with these loans, one would argue that you should have a similar situation also on with the regional banks and smaller banks. Now, is that going to actually happen? We do not know, but it's I just cannot see that we have a significant spike in delinquencies in the commercial loans for CMBS and CLOs, and somehow banks are not affected, right? I mean, their underwriting is not significantly more sound than what CMBS or CLO underwriting is, right? So,
Right.
and naturally, that's particularly the case for offices, for retail shopping malls, for lodging, right? Where obviously we see, particularly on the office side, a significant stress in the CMBS and CLO market, which is, it has been well publicized over the last few weeks, so that's not really a surprise there. But I have talked about in various discussions about the contagion, right? So yes, multifamily might be safe, industrial might be safe, even the residential portfolio a bank has might be perfectly safe. but the contagion that spills over from office, from retail, and potentially lodging, that just has an impact on a bank's equity and reserves, and they need to dial back. It's a normal process. So that's where I think we really are when it comes to the reality of what banks are also feeling at the senior management level. And when we talk to banks about new loans, we definitely get that sense, right? It's much harder to get construction loans. It's much harder to get loans for an existing property. Unless you're a well-established existing client, it's hard to build a new lending relationship with a new local or regional bank. And if you can, then very often they ask for significant deposits. They want that you move your operating accounts over. So there is even if you want to, it's a lot of logistical headache that is involved there. And that clearly gives an indication that maybe on the surface everything looks sound, but senior management at these smaller banks and regional banks, they definitely feel the pressure and they want to get ready so that they have sufficient equity and reserves in place in case the situation is going to deteriorate.
Yep.
Right.
So,
yeah.
well, just real, I guess a follow up there then, Anton, is, and if this is a productive bullet to maybe comment on, but if we look out and know that in the traditional commercial bank space, things are tight. While not impossible, more challenging. So the credit box got tighter, the hoops to get through got smaller. What is in the market as a figurative lender of last resort, so to speak, and what type of deals do you think are doable? Let's say in the next 3 months. I don't have a 6-month crystal ball or a 12-month crystal ball, but maybe in the next 3 to 6 months, what type of financings do you think is doable? And what are your thoughts about those types of loans or that type of access to debt in the market right now?
Yeah. So I think and this is the interesting part when it comes to bridge loans. You still can get bridge loans that are ultimately being securitized. You still get CMBS loans that can be done. So it's not that bad where you do not have the ability to get financing. It's just that very often these are not coming at the terms that you would like, right? And very often also at the lower leverage. And I would say apart from the bridge lenders, CMBS lenders, you certainly also have at much lower leverage. You have life insurance companies that are also an option. And again, I'm not saying that banks are not lending at all. It just gets tighter there, which then gives particularly CMBS lenders and CLO lenders a little bit more of the benefit of increasing the spread and demanding better terms for them, right? In the multifamily space, we are obviously always lucky when it comes to that segment because we have the agencies that are the lenders that are always will be there, right? As long as a loan and the sponsors actually qualify. And that is, unfortunately, for a lot of the borrowers, particularly the ones that took out bridge loans over the last few years at the very high leverage, yes, they could refinance into an agency loan, but they need to bring in additional equity to reduce the loan balance that they currently have because the deal doesn't underwrite to the agency loan at the amount that they currently have outstanding with the bridge loan. So that is really the challenge. So the lenders are there, both for, I would say, industrial, retail, even office, if the price is right, on the CMBS side for a permanent loan. And certainly on the multifamily side, you have CMBS and you have the agencies. So it's only not a liquidity crisis there to get financing. The challenge for a lot of operators is that they need to likely bring in additional equity to get that financing done, right? And
Yeah.
that is in my view is really the key problem. Now, many, right, we have heard, and you probably have heard it in many places too. It's now that theme, oh, we just have to make it to 2025, right? So, in other words, 2023 and 2024 will be very hard, but once you make it through that, everything will be fine. I tend to disagree with that because interest rates are, even if the Fed pivots, short-term rates are not dropping like a rock by early of 2025 or in middle of 2025. I would say generally the view is that we are still in the mid fours with the Fed rate, right, in early
Yeah.
of 2025, and we won't be below 4 probably until a year later, right? So, but once you add a spread to that, we are still at well above 7% with the typical constructional or bridge loan or other short-term loan. So it's only not cheap financing there. Now they say, well, but I'm going with a permanent loan anyhow, so that I don't care about the short-term rates. Well, there is not really an indication that the 10-year Treasury will drop significantly over the next 4 years, right? So we are now roughly close to 4% again, maybe 3.9, but hoping that we will go below 3%, I think is extremely unrealistic. We will likely be somewhere between 3.5 and 3.7 over the next 2 years. And even if you're at 3%, once you add that spread to it, we are still, even for the larger loans, we are still just around the 5% mark. So we are still well above of what everyone was underwriting when they took out a bridge loan in 2021, when you could get permanent agency financing at less than 4%, right? So you still have that gap. So unless you're able to improve your NOI significantly, you still have that challenge of actually getting the loan proceeds that you need. And so what I would say is that anyone who hopes that somehow the situation will drastically improve by then, they'll probably need to go and take the pencils out and start re-underwriting their deal and see whether that really makes sense. And that's just the way it is, in my view.
Yeah, no, I would not disagree. So if the rate environment will play itself out the way it does, are you have any insights as to whether or not pricing is beginning to adjust, or is this still a conversation that folks are hoping that by end of year things have improved and they can hold tight on their sales price, or hold into next year and hope that things improve? Are you seeing anything different?
Yeah, obviously, right. So we talked about the debt service coverage or debt yield for all these loans, right? Whether the NOI supports that. Another aspect, what you're touching on, is the values and whether you can get the LTV for a refinancing, but also if you decide to sell, right? Because the new buyer also is faced with valuations that are not nearly as high as they were during the peak, which is roughly a year ago, right? Depending on the market. We have seen the market peak, certainly on the multifamily side. For other assets, obviously, it's a little bit different, but that was somewhere late 2021 to the middle of 2022. And depending on what market you look at, we talk about already a 20% reduction from that peak, right?
Yep.
And the problem is, even as a buyer, when you look at today's NOIs with a lot of these properties, these prices are still elevated for the financing you would be able to get with those, at least the permanent financing. So obviously not everyone is willing to go with a bridge loan and come up with forward-looking numbers to justify that purchase price. But when you look at going in and getting a new fixed rate loan today, as it was very common, right, until 2018, where you could get a 75, sometimes even 80% LTV for right out of the gate, and the cash flowed out of the gate. If you want to have something like this, values still have to come down, right? So they are still, from when you take that criteria that you are able to get a 70-75% leverage with a permanent loan based on in-place cash flow, not forward-looking pie-in-the-sky projections, but what is currently in place with normalized expenses as the new buyer, you are still far off of what you are really able to pay, right? And I think that is, again, the element that a lot of owners and deal sponsors that they do not realize. We are going into an environment where not only do you have the DSCR and debt deal challenge, but you also have the valuation challenge, right? And all that combined makes it hard when you feel, well, I cannot refinance out of it, let's sell it, that you find a buyer that is willing to pay the price that it gets you out of that existing loan, and still hopefully are able to return the capital to your investors. Right.
Right. Yeah. And it's striking to think that that there are certain conversations we have where a year ago there was optimism and still this kind of bullishness that the underwriting was sound, and even with the adjustments that were expected on the back end of the bridge loans. And a year later, we have all this shock, and there's still, I don't want to say misdirected hope, but just that aggressiveness that, okay, things are going to improve, but at least from where we sit, and maybe observing a similar set of facts that our investors that we talk to are observing, I think we just see a bit more conservative and those steps that are most likely to play out, and the changes need to occur to loosen things up. It feels like it's still a bit of a challenge, over the next year plus or so. I mean, you made the comment, that make it to 2025, right? That's some hard work ahead for some of these properties, and we're not even necessarily touching on another conversation, but what we've mentioned, I think last time, is NOIs are being pressured constantly by increases in expenses. So it's a tough environment. I think that and it is an environment where we can have meaningful conversations, add good value, help people know what we're seeing, what we're hearing, and share our insights as to how to help them solve their problems.
Yeah, absolutely right. I think that's a key message. You need to have that discussion with your team. You have that discussion with us or any other debt advisor. What are the options here, and what are the realistic options? Not what you are hoping for, but what is realistic. You need to essentially redo your pro forma and figure out whether that pro forma makes sense to inject additional cash to get over that bump, or whether it's better to agree to sell the property and potentially have a loss on the capital side, right? Because that is the hard part, and you need partners that can help you to really identify that, whether it makes sense to go in one way or another. Not all deals should be just sold and generate a loss, because they have a chance to survive, but that's also a timing issue. are you and your investors willing to wait another 3 to 5 years, which is really in most instances necessary to make sense if you have a capital injection, or is it better just to take that loss, right? So it can go
Yeah.
both ways. And unfortunately, as you know, right, we see a lot of owners and deal sponsors, they're like deer in the headlights. They just do not know what to do, and they hope that somehow it gets better in 2025. And this
Yeah.
is really, I think, our message. You cannot just assume that it will get better. The signs are definitely not there. Interest rates will be higher. And if they are significantly lower, and we have touched on this so many times, if interest rates, whether it's short term or medium term, like the 10-year treasury, are significantly lower than what everyone anticipates, meaning the 10-year the Fed rate, let's say, significantly below 3%, 10-year treasury significantly below 3%, we have a significant distress in the market, which
Yeah.
means that yes, your index rates will be low, but your credit spreads will likely be significantly higher. So your overall borrowing costs could very likely be even higher than what it is today, if you are able to get a loan, right?
Yeah.
Because
And
then you have a complete credit squeeze. It's very hard to get financing. And so you better get ready for that scenario, because it will not be pleasant. And we have seen it in 2009 and 10 when we went through this for cash flowing assets. It's
yeah.
not easy to get financing when the credit markets are coming to a halt, right?
And just as in a very basic level, you know, rate in general is the buildup, and adjust this as I say it, Anton, but it's the related risk-free rate, plus we start adding on additional premiums for different to compensate investors for different type of perceived risk. And over time, as you're pointing out, even if the base index rate is very low, in those environments, the perceived risk could be very high, causing little change or improvement, if at all, to the total rate that you would experience if it's a permanent loan. Or anyway, but you get my point. It's just trying to come to a bare bones explanation of how we build up rate, because I think that gets lost sometimes when we have these conversations. You and I get it, but I don't know if everyone in our audience knows what we're speaking to when we talk about these spreads or premiums or credit risk premiums. And is that a good basic explanation, or anything you want to add to that?
Yeah, I would say to the most simple picture probably everyone understands is on the residential side. Obviously, we are not active there, but there it's everyone knows that if you have a credit score that is lousy, let's say in the 500s to 600s, you have a significantly higher mortgage rate because of your credit risk, right? Compared to a very good borrower that has 750 or 800 credit score, right? Meaning that the funding for the lender is at the same rate wherever they get the funding, but they add a much larger credit spread to that higher risk or the perceived higher risk borrower, right? And the same thing can happen is happening on the commercial side. So every single deal on the commercial side is also priced based on that perceived risk. And obviously, the stronger the deal sponsor and the guarantor is, the stronger the perceived strength of the property is, the lower that credit spread is going to be, and the combined interest is lower as a result. The problem is when the credit markets are in distress, even the ones that are perceived strong borrowers, and even if the property is a strong asset, that doesn't matter at that point, because no one is willing to lend. And the few that are willing to lend, then they can increase their spread, because then they are the only lender in town, right? So,
Right.
so that is that is the issue there now. Some people will tell us, well, but can we talk about Fannie and Freddie, because they have a mandate to lend, right? So if you're in the multifamily space, you're protected. Technically, yes, but we also need to realize that both Fannie and Freddie, they are still securitizing these loans and they sell them into the marketplace. So they, unless the government is now backstopping these loans and buying them at any rate, as they have done in the past, right?
Right.
At any price, then the market price would also go up. So in order for that to happen, the government really needs to, again, to be stepping in and be willing to buy these agency loans, because the open market, the private market, would not be willing to buy it at those prices, right? So there, potentially the rates will be lower, but it's only if the government is willing to, again, pick up the task and increasing their balance sheet with all these agency CMBS loans, right? Which is what right now they are desperately reducing that balance, right? So doesn't mean that they are pivoting back to that activity, but that is really an artificial environment and not sustainable.
Right. So, and I thanks for explaining that, because, looking back at some of what we covered as far as, where we think the Fed what they may or may not do by the end of the year, feels like there's not a lot of change coming. There's a lot of expectation in the market for some improvement. Let's hold on for the next 18 months, 24 months. Hope and prayer, and our advice is don't rely on that. Have a meaningful conversation. And I guess, maybe the backdrop is, for folks that are either experienced with multiple cycles, or this is their first full cycle that they're beginning to go through, without being alarmist or doom and gloom, when to get through a cycle, there is that trough sometimes you have to weather. And I don't think I'm any expert in seeing where we are, but it does feel like we still have to go through a significant amount of change in the market, both from a seller's perspective of, are they comfortable to sell? And if so, what cap rate? From a borrower's, investor's perspective, if they're going to buy, what type of equity are they willing to bring in? What are the acceptable returns? What's available in leverage? So we are not on the inflection point that we've might have been when you talk to some of these gurus that got into multifamily between 2010 and 2014. A lot of those folks timed it well. I don't know that we've necessarily come into that part of our growth cycle again. So hopefully some of what we're sharing is giving people tools to think about how to solve the problems ahead of them. Because I don't know that we're necessarily in that point where it's throwing darts at a wall and you're going to make money. I mean, it doesn't feel like that is anywhere in our immediate future.
Yes. So I think your message here is don't expect the market to bail you out, right?
Correct.
Obviously, 2011, 12, 13, 14, 15, whoever entered the market then, there was still plenty of meat on the bone, right, as you want to call it that way, for mistakes, even for downturns. You were able to get very good financing. The pricing was just much more reasonable, right?
Yeah.
And all these problems that we are facing now is really, certainly on the multifamily side, with all these bridge loans that are now coming due, is really the result of that craziness that we have seen in the market, with prices just going through the roof. And if prices shoot up, prices need to come down, right? There was no justification for prices to go up by that level, but everyone believed that this is the new normal, and obviously that wasn't the case. Well,
Yep.
Well, so we certainly are happy if any listener who has an issue there, right, where they feel, look, we need to come up with a solution, and we need to have a strategy how to figure this out. We are happy to be on a call with you guys. So thanks, John, for your time, and hope this was helpful to our listeners. And see you next time.
Thanks, Anton. Talk to you soon.
Yep.